And I will say, absolutely, this is sustainable. I mean, we're modeling close to $4 billion in Zoom revenue this year. And as you noted, it's about 50% year-on-year growth. I think the issue with the stock and the reason why we've got a hold rating is if you think about the growth this past quarter, close to 200% year-on-year growth, we've got them exiting the year closer to 20%, right? And so when you think about forward growth, it's probably in the mid-teens to 20%. At 21 times next year's calendar sales, it's a little bit tough to make the case for the stock with current valuations.
Well, even as sales have grown, so have their cost of goods sold, gone from like 12 million 5 years ago to more than 800 million. They're adding people, they're adding computers, they're adding whatever. But I think what's most impressive to me on the balance sheet, the income statement, is they've got, not only do they have operating income, they used to not, is that it's over $670 million or thereabouts. So even with that growth in actual cash flow, you just think, Matthew, maybe the stock, just kind of got ahead of itself.
Yeah, no, absolutely. I mean, this was the poster child for work from home, right? It's a huge, huge winner during the COVID timeframe. And absolutely, I mean, we think there's a lot of sustainability to the revenue trend. You hear about a lot of hybrid work that's going to become the new norm as we go forward. And as you alluded to, right, the ability for this company to hit $4 billion in revenue in terms of annualized run rate almost overnight, that's a lot of scale and there's a lot of benefits. And you think about margins, operating margins that were north of 40% this past quarter. I mean, you have companies that work towards that and it takes them longer than a decade to get there. So certainly a lot of scale that comes with the growth the company has seen. I just think it's a little bit tougher at this point when you think about the prospects of decelerating growth. The company grew about 325% a year ago, probably going to be growing in the mid-teens to close to 20%, at least on our estimates. It becomes challenging to make the case for valuation, at least on our part, when they're 20 times sales, and the peers are probably somewhere in the mid-teens in terms of EV to sales next year.
Well, the bulls would make that case, Matthew, by saying, yeah, but the stock is down, from 475 or 500 a share, and the valuation has come down with it.
It's certainly come down. And by the way, there are a lot of growth avenues Zoom is pursuing, and we commend them for that. When you think about Zoom Phone, when you think about the enterprise opportunity, there's a lot of avenues they can tap. The one thing I would really caution on, though, is pre-pandemic, Zoom generated about 20% of sales from businesses with less than 10 employees. That number is almost doubled. About 37% of sales right now come from very small businesses. We're talking sub 10 employees. And if you think about that in context, that's about $1.5 billion in annualized revenues coming from very small businesses. That's the cohort that's most prone to churn. And what I mean by that is when you've got reopenings across the world, that cohort is the most prone to going back to the office, probably letting go of their Zoom subscription that they signed off for during the pandemic. And so for Zoom, it's a real challenge to grow in the areas like enterprise, like international and phone, amidst some of the churn you're going to see in the next couple of quarters in that smaller cohort.
Shepard Smith here. Thanks for watching CNBC on YouTube.